You could hand the IRS a fortune when you sell your home, and most sellers never see it coming until the tax bill lands. But there is a rule that lets a married couple keep up to $500,000 of that profit completely tax free. I am Warwick. I have watched sellers leave real money on the table because nobody explained this to them. So let me make sure that is not you. Here is the rule, and it is the single most powerful one in the whole tax code for a homeowner. It is called the Section 121 exclusion. If you are single, you can exclude up to $250,000 of profit from the sale of your home from taxes. If you are married and file jointly, that doubles up to $500,000 tax free. Now, let me be clear about what that word exclude really means because people get this wrong. That is not a deduction that shaves a little off. That is not a delay that comes back to bite you later. That is gain the government simply does not touch, does not tax ever. For most homeowners in this country, that means the entire profit on the sale of their home comes home with them and not a dollar of it goes to the IRS. Now, here is the part that trips people up. So listen closely because this is where the money is won or lost. It is called the 2 out of 5 year rule. To get the full break, you have to have both owned the home and lived in it as your main home for at least 2 of the last 5 years before you sell. Notice I said two things: owned it and lived in it. And here is the good news that a lot of people miss. Those 24 months do not have to be back to back. They just have to fall somewhere inside that 5 year window. So if you moved out, rented it for a while, and moved back, those months can still count. But miss that test by a month or two, and you can go from paying zero to owing tens of thousands of dollars. That is why timing your sale is not some small detail to figure out later. It can be the single most valuable decision in the entire transaction. Third, and this is the one that quietly costs people the most, your profit is not the sale price on your purchase agreement minus what you originally paid. It is your sale price minus your basis. And your basis is not just the purchase price. Here is the part worth real money. Every qualifying improvement you made to that home over the years gets added to your basis. The new roof, the kitchen remodel, the addition you built, the new heating and cooling system, even the deck out back. Each one raises your basis, and a higher basis means a lower taxable gain. So think about that. If you have been throwing away those receipts and invoices for the last 15 years, you may be about to pay tax on money you already spent improving the place. Go find those records, dig through the files, the emails, the old bank statements. They are worth real dollars back in your pocket. Fourth, do not count yourself out if you fall short of the 2 years. A lot of people assume that if they did not live there long enough, they owe the full tax and they just accept it. That is a mistake. The IRS allows a partial exclusion if you had to sell early for specific reasons, a job move a certain distance away, a health situation for you or a family member, or other unforeseeable events in your life. You do not get the whole break, but you get a slice of it based on how long you were actually there. So even if you only lived in the home for 1 year out of the last 5, you might still shelter a big chunk of your gain. A lot of sellers who assume they owe the full tax actually qualify for this relief and never even ask about it. Fifth, know how this shows up on paper because the government already knows about your sale. At closing, in a state like Florida, you sign the deed that transfers the home, and the title company often reports the sale to the IRS on a form called the 1099-S. Here is the trap. If that form gets filed and you say nothing on your tax return, it can look like you owe tax on the whole thing, and you may get a letter asking where their money is. So even when your gain is completely excluded, you may still need to report the sale on your return to claim the exclusion cleanly. It is a 5-minute step for your accountant. Skip it, and you can turn a tax-free sale into a stressful letter from the IRS months later. Do not let a simple piece of paperwork undo the biggest break you get. Here is my one warning, and it is important. This is the general rule, And your situation has details that can change the math. A home office you deducted, a period where you rented the place out, a property you inherited instead of bought. Any of those can shift the numbers. I am not your accountant, and this is not tax advice for your specific return. What I am giving you is the map. So you walk into that conversation with a professional already knowing the right questions to ask. Because the sellers who lose the most are almost always the ones who never knew there was anything to ask about. So remember the three moves. One, the exclusion is 250,000 single, a half million married, completely tax free. Two, you need 2 of the last 5 years living there, so time your sale right. And three, add every improvement to your basis and shrink the gain. Get those three right, and the profit on the biggest asset you own stays exactly where it belongs, with you. If you are selling in the next year or two, this one rule can be worth more than any renovation you will ever do. Subscribe so you do not miss the moves that actually protect your money. And when you are ready to sell, get it done with someone who is thinking about your bottom line, not just the sale,